It's Christopher Marr with MMG Real Estate Advisors. Here today with Chip Hayes, Senior Loan Officer with Legacy Home Loans, with over 20 years of lending experience. Now, we know that serious home buyers know that the first step in the home buying process is to get pre-qualified. So Brooks and I thought we'd make a quick, informative video regarding the most frequently asked questions about the loan process. Chip, let's begin with discussing down payments. Can you explain the typical down payment requirements for various loan types?
Certainly, Chris, and thanks for having me. Most VA loans come with a 0% down payment requirement. FHA loans require a minimum down payment of 3.5%, while conventional usually requires 3%. However, jumbo loans have a significantly higher down payment requirement, typically around 20%.
Also, how does the size of the down payment impact the interest rate?
Yeah, Chris, that's a really good question. Generally, a larger down payment leads to a lower interest rate on your loan.
Moving on to credit scores. What are the key things borrowers should know about them?
Online credit scores like FICO 8 or FICO 9 tend to be 10 to 25 points higher than the scores used by mortgage professionals. We consider the middle credit scores from the three major credit bureaus, TransUnion, Equifax, and Experian.
And can you explain the minimum credit score requirements for different loans?
Certainly, Chris, that's a great question. FHA loans require a minimum credit score of 580, while VA loans technically have no set minimum. Most lenders are looking for at least a credit score of 620. For conventional loans, a middle credit score of 620 is typically required, and jumbo loans usually demand a credit score of at least 700.
I noticed that you mentioned an optimal credit score of 760. Could you elaborate on that?
Yeah, I get that question a lot. Sure. A credit score of 760 is considered ideal for securing the best prevailing interest rates, but going beyond 760 doesn't usually provide any additional benefit.
Chip, here's a common question that we get. How can borrowers improve their credit scores?
That's a really good question. We deal with this daily. There are several ways. First, review your credit report for errors. Correcting inaccuracies can make a significant difference. Second, paying down or paying off credit card balance is a quick way to boost your score. Ideally, we'd like to see balances at 10% or less of your credit card limit. If that's not possible, consider asking for a credit limit increase or opening a new credit card to increase your available credit. This can make a positive impact on your score.
Now, let's move on to debt to income ratio. Can you explain the significance in the qualification process?
Yeah, certainly. The debt to income ratio is crucial in determining the maximum loan amount you qualify for. It's calculated by dividing your total monthly debt payments, including the new housing expense, by your gross monthly income. For self-employed individuals, it's a bit more complex. It's based on adjusted gross income.
You know what might be good is if you could provide an example of how debt to income ratio works in practice.
Yeah, that's a really good question. I'm happy to touch on that. Let's say you're looking at a sales price of $700,000 for a new home. We're going to use 20% down payment, resulting in a $560,000 loan amount. With an interest rate of 6.75 on a 30-year fixed rate, it's going to give you a monthly mortgage payment of approximately $3,600. Property taxes might be around $640 a month, and homeowners insurance is roughly $80 a month. The total of all monthly payments is $4,320 a month for this particular scenario. The typical debt to income ratio ceiling for qualifying is roughly 42%. So your gross monthly income would need to be approximately $10,200 per month to qualify in this particular scenario.
Expenses are always something in the home buying process that people have questions about. Are there any additional expenses that borrowers should be aware of in the qualification process?
Yeah, great question. Everybody wants to know what's the bottom line. Are there any additional expenses for a home loan? And in certain scenarios, you might have PMI if you're not putting 20% down. If you're buying a condo or a townhome, you're looking at association dues. That's typically it.
This is one that Brooks and I get time and time again when we talk to buyers. They want to know what daily financial indicators we monitor for mortgage rates. Like you, we watch the bond yields on the 10-year Treasury. But can you explain the correlation between the 10-year Treasury bond and mortgage rates?
Yeah, Chris, that's a great question and one that we have to answer daily. When there's inactivity by the Fed, the best way to track movement of interest rates is by watching the yield of the 10-year bond. It's pretty simple. If the yield drops, usually interest rates improve or drop.
Well, Chip, I can't thank you enough. This is great stuff. Thank you for explaining the qualification process and credit considerations in detail. This was super informative. If you have any specific questions regarding any of the topics that were covered today or your specific loan scenario, please feel free to contact Chip Hayes with Legacy Home Loans directly. His information will be in the description below. Well, that's a wrap on this video. Remember, we're here to help you navigate the home buying and home selling process and be a trusted resource that you can rely on. If you feel that you know someone that would benefit from this information, give it a share. And until next time, thanks for watching, and we'll see you on the next video.